Accounting concepts and standards. Introduction. In this module, you will learn about the basic accounting concepts and accounting standards of the UK. You will also learn about the International Accounting Standards and International Financial Reporting Standards. Topics to be covered. Introduction to accounting concepts. Introduction to accounting standards. Accounting standards in the UK. International accounting standards. International financial reporting standards. Introduction to accounting concepts. Accounting concepts are used in the construction of financial statements and the recording of accounting transactions. These concepts act as a guide to the proper way of recording and presenting accounting transactions and statements. Accounting concepts are not laws in the traditional sense of the word but are meant to provide a framework of informal rules and guidance for those who are intended to construct the financial statements of business entities. For limited companies, these concepts are integrated into a range of accounting standards. Accounting standards are a series of continually evolving statements and guidelines as to how the accounts of limited companies are constructed. These standards have evolved over time and are gradually being more closely integrated into a common set of international standards. Over the last 30 years, the International Accounting Standards Board, IASB, has sought to develop a set of accounting standards that an increasing number of countries can apply. Some countries still operate under their own GAAP rules and regulations. It is believed that the development of the IASB and the standards that they publish will gradually supersede the national standards and frameworks produced by individual countries. Business entity. The accounting records of a business should be for the business alone. All items that relate to the owner's personal dealings should remain separate from those of the business. In this way, the business is said to exist as a separate business entity. Implications of this concept are that expenses incurred by the business are the only ones that appear in the business records. This distinction can be blurred when an asset is used for both business and personal use by the owner. For example, a vehicle may be used for both business and private purposes. In this case, the financial statements must only show the actual business expenses. Any use of business resources for private matters should be recorded in the accounts as drawings. Going concerned. The assumption is made that the business will continue trading into the future and that the business and its assets are not expected to be sold off in the near future. As a result, the valuations of the assets of the business should not be based on potential resale value but on more objective, verifiable means, such as cost. Accruals. The accruals concept means that the financial statements are constructed on the basis that incomes and expenses are linked to the period in which they are incurred rather than when the money for the income or expense changes hands. For example, the sales made in one period of time would appear as income for the period even if the receipt of money for the sales was received in a later period of time. Prudence. The concept of prudence requires the accounts to be constructed with a fair degree of caution. The implications of this are that profits should not be anticipated before they are reasonably certain. Similarly, the valuation of assets should not be based on optimistic overvaluations. For example, it is common practice that inventory should always be valued at lower cost or net realizable value. The prudence concept links with the requirement of reliability for the financial statements. This concept is sometimes known as conservatism. Consistency. Any accounting methods that are selected should be used in a consistent manner. For example, the depreciation policy for non-current assets should be maintained consistently so as to ensure fair comparisons to be made with earlier accounting periods. This can be linked with the requirement of comparability for the financial statements to provide a true and fair view of the business's financial position. Materiality. A material amount refers to a monetary amount that is significant enough to be recorded separately. For instance, many businesses will group together small items of expenditure as either general or sundry expenses. More importantly, expenditure on some items could be classified as either an asset or an expense. This will depend on the side of the business. For example, a business may consider expenditure on office furniture as not material, and this would be treated as an expense. However, a smaller business may consider some of the office furniture to be material enough to be recorded as a non-current asset. Duality. This concept ties in with the accounting equation, which is assets equals liabilities plus owner's equity. Each transaction can be viewed and considered to have two effects on the business. One is on the assets of the business's financial position, and the other one is on the financing of the business. These effects will always be equal to one another. Historical cost. Where possible, assets, non-current and current, should be valued at the original cost of the asset, known as historical cost. Historical business's financial position to cost is chosen as it is objective and verifiable, which means it is superior to subjective valuations which may be lacking in prudence. Even if historical cost is applied, there are exceptions to this rule, such as when a business provides for depreciation on non-current assets. Realization. A sale should not be recognized until the legal title of the goods sold passes from supplier to customer. This is not necessarily the moment when money is received from the sale. For credit sales, it could be when the goods are issued to the customer.